Move on.
If you were looking at the top components in the S&P yesterday, you'd be like, why aren't we having a good day? Well, there's some factors going on under the hood that we're going to discuss with this, and it's all about cash and it's all about debt. And if you got a lot of debt, you're going to get destroyed in this market, rising interest rate market. Who knows, 13.5% if you ask Rich Santelli. We'll dig into the details of this of the debt and credit and cash. We'll talk about one earnings report, double upgrade of Hewlett Packard. Ooh, we'll see if Warren sells into that. It's Tuesday. It doesn't look like a turnaround Tuesday. It's pre-market prep.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. We got a good show lined up for you today. Let's run through some of the commodities and futures and get right to our topics. S&Ps, we got to start getting up at 4 in the morning. Made that pre-market high near the intraday high from yesterday, and we're slumping just off the low, down 22.5 handles at 43.0175. The buck inflicting more pain on investors, up 23 cents, 106.84. Another leg down in the bond market, down almost a point, 111.5. Crude losing its luster in the 80 handle now, down 47 cents at 88.34. Gold getting beat up with the buck and the rates too. Gold down 560 at 1841.60. Silver over 23 on Friday, now coming close to 21, down 13 cents at 21.29. Bitcoin futures, they're down $475, giving back some of yesterday's gains at 27,675. I'm going to bring in Triple D here. Triple D, you know how sometimes I send you a picture of my monitor, because I have the top components up and then what the overall market's doing. And you saw the gains in some of the Apple, Microsoft, Google, Amazon, Nvidia, of course, got the conviction buy. Meta was up, and the market didn't care, Dennis. What is it? What is these big tech stocks and all the cash?
You've got some separation here, and this is more just, this is all on rates. It's not more on rates. It's everything is about long-term rates here. They're talking about it nonstop, obviously, in the media. We're talking about it nonstop in the media. The trading action is all about rates right now and its impacts on companies here. Let's bring in Money Mitch because he needs to be a big part of this conversation as well because he has thoughts too. So Money Mitch, we're going to bring you in here right now. I mean, we've got, this market that is basically separating here now. And what is getting hit the hardest is the companies with a lot of debt. It's getting hit the hardest. Why? Because they're going to have to pay more if rates stay up for a longer period of time. So let's start right with, and we're going to come back to oil and we'll get into all that because it all encompasses into it. But let's start right with the XLU because that was possibly one of the biggest down moves we have seen in the XLU in years. It was down 5% at one point in time yesterday. Down basically, we're talking about 15% fall in 6 days. This is stuff that people are hiding in. This is stuff that's supposed to go up when the market gets, into trouble. This is defensive, your classic defensive stuff. Utilities, drugs, staples, all defensive. That's the stuff that they're hammering. That's where the problems are. I mean, look at those stats. Money Mitch, fantastic stats you're seeing here. But the performance in the last week, when is the last time we had utilities down 10% in 1 week, Joel? Yeah. I mean, this is an incredible sell-off. And we warned about this because, we were talking about the potential for, people hiding here in these products and saying if rates are higher, obviously 3% dividends are not very attractive. The XLU dividend is not nearly as attractive as the cash yield. It's still only 3.81%. So it's a problem. Yes, I'm getting hit on the Enbridge. The Enbridge has an 8% dividend, but there's no prisoners here right now on XLU or any of this stuff. And the reason for that is they have a lot of debt. Utilities have a hell of a lot of debt. If you just want to do a fun exercise and you want to see the stocks getting hit the most, you think Enbridge is bad? Check out NEE, Nextera Energy, NEP, obviously parts of this as well, Nextera Energy Partners. And I mean, NEP is down 50% in 4 days. NEE, which is the biggest component in the XLU, the Kramer loved stock that he says you had to own at $85, has just lost 25% of its market cap in 4 days. This is a crash. This is an unbelievable crash in a very conservative stock. But what is the problem here? Go to your trusty Benzinga Pro and we will tell you what the problem here is. It's debt. This company has $60 billion in debt. $60 billion in debt. It has a market cap of $100 billion. So basically, 60% of its market cap is all debt. What do banks have? A hell of a lot of debt. They're getting hit hard here now too. What does Apple not have? It doesn't have a lot of debt. And people will say, oh yeah, they do. Look, Apple has a lot of debt. They have $98 billion in debt. What are you talking about, Denny? They have $2.7 trillion market cap. $98 billion on $2.7 trillion market cap is 3% of the market cap. If I'm doing that math right.
Where do they have that debt at? Where do they have that debt at? Would they have it in rates from
drop in the bucket for Apple? It's a small amount compared to the market cap and compared to their revenues.
They'll just pay it off.
In the bucket for NEE. So you can clearly see why the Magnificent Seven is really holding up well. Like Nvidia, and people are going to argue me, oh, they do have debt. Yeah, a lot of these companies have debt. They have it just structured, But I mean, Nvidia's debt is $8 billion. They have a $1 trillion market cap. They could do a share offering and pay off all their debt just like that. So I mean, the stock would go down 2% on a share offering, and they could just take that money and pay off the debt, and they wouldn't have to worry about it anymore. So there's a reason that the Magnificent Seven is actually holding up well, is that the majority of these companies, Tesla's its own stock, so you don't have to talk Tesla, but Tesla, even the debt in Tesla isn't that much anymore. So I mean, you can clearly see that these companies are holding up well because they don't have debt. Microsoft, very little debt if they have any at all. Google's debt, and I am ranting here, but I'm trying to make a point here, and then I'm going to let you guys talk. $1.7 trillion in market cap. Google has $11 billion in debt. I mean, what is that? Like 0.5% of their market cap is debt compared to Nextera Energy, which is 60. So you can see which companies are being punished for higher rates, because if those rates stay higher, that is going to squeeze the hell out of all of their margins. That is why utility stocks are getting hit. That is why bank stocks are getting hit. This is why oil stocks are going to start to get hit. Oil stocks have been forgiven, but they have a lot of debt too. And I think oil stocks start to get hit here as well. Did make a new high on the recent move, even when oil did. So keep an eye there. But thoughts, guys, I mean, this is the reason why you're seeing this separation in stocks, and people are like, why doesn't Apple sell off? Well, they don't have a hell of a lot of debt, and this is a debt problem. This is like a yield problem. So when you've got this much debt on your books, like an Nextera Energy, and yields are flying high long term, they're like, oh my gosh, even if they're locked in, where are they going to have to refinance this debt?
Jay put in here about Apple's debt. They issued 30-year debt at 1.5% 3 to 4 years ago. I mean, so when that, 30 years.
That's an asset.
Yeah, it is.
That's an asset.
It is.
I mean, it's small, but that is an asset. So it's the same thing. Like I borrowed money, on my one rental property at 1.62% for 5 years. It's 3 years into it. That's an asset for the next 2 years. I got to pay that off. That's like free money over there. I can throw it in it, and I am doing that. I'm throwing other cash into a GIC at 5.2, and the same bank at Scotia Bank. I got a GIC 5.2%, and they're paying me 5.2, and I'm paying them 1.64. I'm literally arbitraging the bank.
A little arbitragey there, right?
This is not good for the bank.
No, not good for the banks. The banks have, they've had their own problems, right, with the credit crisis. But and we gotta, you gotta acknowledge. CNBC, one of our competitors. Rick Santelli. He came on yesterday and he thinks that this is just the beginning of rate rises. He was calling for what, 13.5%, 14.5%?
In 10 years, he thinks rates could go to 13%.
Well, S&P will be under 1,000 by then. I mean,
Yeah.
if it will be over. We won't have
Before we go into the
pre-market
Rick
prep.
Santelli, because I want to rant about that too. I want to get Money Mitch's thoughts here because you're
Okay.
seeing the same type of market here. Mitch is young. He obviously didn't see, rates back, when they were higher. I started trading and the rates were, elevated to even to above this when I started trading 1999. But the big difference was we just didn't have $33 trillion in debt, and every consumer wasn't just laden with all this debt. So it's just a big difference here now. Money Mitch, I mean, you're a young guy here. What are your thoughts here? You see, rates rising here. What are your thoughts?
Yeah, let's go through what you just talked about. The first thing being that mega tech holding up yesterday. And one thing that we can clearly see just even on this, and shout out to FinViz, I just grabbed this as an easy chart to look up. You guys can go into the groups and then go under performance to look at this. I look at this all the time to just kind of find where the rotation's going. You can see technology just kind of holding in for the week, and then in the month down about close to 6%, but just holding in here. And I think that that's what we're seeing is that where's the money hiding? The money's hiding in big tech, and it's still not getting wrecked, right? If that moment changes, we really need to be careful,
There you
right?
go.
We start
Yeah.
to see Nvidia change some of the big leaders right now, then we got to be careful because that's what's holding it up. And then I look at what normally you would go to in a time of uncertainty, right? You'd probably look at defensives, right? But not in this environment. And then for utilities to go down 10%, and it felt like it was just yesterday. It wasn't really the week, right? I mean,
It felt like yesterday. Yeah.
yesterday, right? That was 10% right there. And this doesn't happen in normal uncertainty environments. Normally, we look for safety. There is no safety right now. The safety is what? Just hold your cash. That's the only thing you can do right now. And in this type of market, it gets really difficult because even in healthcare, where you think maybe, all right, GARP, maybe we're looking at growth at reasonable value, even that's not moving. So where do you go? Because I don't see too much more in technology for the year. I mean, we're still up 34% for the year, 31% relative. So I don't see too much more in tech. Where do you go in this market?
I think they're hiding. The reason they're hiding in tech is for those reasons that I cited, is that there's very little debt in a lot of these companies. And so the margins are really high. I mean, some of these companies have 30, 40% margins. Some of these, other companies are getting squeezed. The margins are getting squeezed. And I mean, if you could have predicted, this incredible long-term rate sell-off here 3 or 4 weeks ago, it was money to be made by shorting all these stocks. But is it over? That's a question. I mean, if Rick Santelli, and let's talk about his scenario, he's talking about rates eventually going to 13% over the course of the next 10 years. If that comes to fruition, to your point, Joel, is the stock market just is going to get hammered. Maybe it can go slowly and try to figure it out, but we're just so levered. I mean, I just can't see how it's even possible. But I mean, I guess anything is possible. But I think it's more of a headline to grab, like more of a saying that to grab headlines. Everybody's talking about it today. They had them on Squawk Box this morning. CNBC's viewership has been dropping and dropping. We know that. So they need to do stuff like this to try to grab headlines, and they're grabbing some headlines here. So, when we're talking about it, I mean, it's a bold call. I don't think there's any chance rates go up, but are rates done? That's the question. I came on here 3 or 4 days and felt we were near the peak of the cycle. Well, now I'm questioning that because of the action in XLU. I mean, I'm telling me, like, we're seeing deleveraging of all debt assets here. And that is a concern. And, as a trader, you have the luxury to change your mind. As a trader, as a long-term money manager, you're managing billions of dollars, it's hard to come in and out. You got price impact of 2-3% when you're moving stuff. You can't just get in and out in one trade. As a trader, we have that luxury. So take advantage of that luxury. I, in all likelihood, will sell my TLT today. I bought it at 87.50. I looked at where I bought it. I got paid a little dividend. I think it was like 28 cents. So I'm averaged in like 87 a quarter. So I'm down $1 on it. I'm probably it's probably the best dollar loss I can take because it looks like I'm early on the call. I'm often early. I feel like I'm early. I think if you're buying TLT for the next 10 years, I think you're going to be fine. But I'm obviously early. How do you know you're early? You're losing money. So I'm early on the trade. But when I see action happening in the XLU, I thought utilities could get hit, but I didn't think they're going to get hit this hard. Something else is going on. So when I see that, it makes me think maybe we aren't at the peak cycle. So I'll retract, my opinion from 3 days ago, thinking we were close to a peak cycle. You can't have action like the XLU happening and be at peak cycle. Maybe that was capitulation, and maybe this is the bottom, and maybe I'll be selling TLT at the bottom here today. But I think you've just got to be cautious here because obviously rates want to go higher.
I'll go ahead and add to that conversation, of course, using the CME Fed tool here. You guys can see that about a week ago, we were at 83% of the current policy, right? Not getting that interest rate to go higher. Now we're starting to decline. We're going towards 72 and 74%, but only it seems like a 25% chance for another 25 basis points. Do you think the CME Fed tool has it right this time, or could they possibly have it wrong?
If long-term rates keep going up like this, there's no chance the Fed even raises the next meeting because this is
Yeah, you don't
right
have
now,
to.
this long-term rates is a serious issue here. Fed controls the long-term, the short-term. They can't control the long-term. So, I mean, this is it right now hammering stocks. They can't have stuff like this happening. So I think like worrying about the Fed is not even worth worrying about right now. We got to worry about what is happening with treasuries.
Yeah, the long
There's
end
bigger
is-
issues
yeah.
than the Fed here right now, and this is maybe bigger than the Fed. So I do think if you're buying utility stocks here, I do think, if you're nibbling into some stuff, I think 5 years from now you're happy, maybe in 5 months from now you're happy, but it is completely catching a falling knife right now, and I cannot believe that sell-off yesterday. And like NextEra Energy, just going back to that one,
Oh,
I know I'm
man.
repeating myself here, but it's important to understand. NEE is a stock that typically moves 50 cents a day.
Yeah,
It just
not
lost
like that.
15 points in 3 trading sessions. Enbridge is a stock that typically moves 50 cents a day, and I'm long Enbridge. And I'm going to hold Enbridge because, one, it's got an 8% dividend, which is a lot higher than most of them. 2 is I know it's the biggest utility company in Canada. I pay them bills all the time, and I don't think Enbridge is going out of business. But 3, the reason it is going right down right now is Enbridge has a lot of debt, and they just took on more debt to do that deal, which they're regretting probably right about now because obviously, if you're looking at the debt, I mean, they have $70 billion in debt and a $70 billion market cap. That's even worse shape than, NEE when we're looking on that. So obviously raising rates is hammering these stocks. And maybe, they should be getting hammered because I don't think anybody predicted these rates going up like this quickly.
It's like everyone has the inflation numbers that are coming out, next week. It's like it's a foregone conclusion that that they're going to be bad, or maybe not even. I mean, maybe even if they're not good enough, if they're flat. I mean, the market has said it takes on certain personalities at certain times, and then has this kind of momentum, and I'm not even sure if the good inflation numbers are going to come, and then if after that, then we fall in the Q3 earnings season. The market is really at a precarious state after having just such a wonderful year. I mean, it's still an excellent year so far, and everything just seems like doom and gloom. So psychology of the market is so important.
And you're completely wrong with it's an excellent year here because Joel always has his S&P blinders on. This has been an absolute disastrous year for a lot of stocks. You have a lot of stocks. Yesterday, Joel, the S&P was flat. There was 450 of the 500 stocks were down. That's the truth. Go look it up. You have 90% of the index is down and it's flat because it's so heavily weighted. Those companies that don't have a lot of debt. So, I mean, it's just a very poor indicator for the overall market, a very, very poor indicator.
All right, if you're in the triple Qs, it's been a good year.
It's been a good year. Again, it's the same 7 stocks though, Joel. It's the Magnificent 7, and Mitch knows it. It's the same stocks. Bring up the IWM. The IWM is almost at its 52-week low. We're not even that far from it. We're almost at 2023 lows. That's a diversified look. Look at the XBI. Tell me it's having a good year. It's making new 2023 lows. There's, how many biotech companies, small biotech companies in there? All have a lot of debt. It's all got something in common. You can see the stuff getting hit. So what we try to do on this show is identify patterns. You can clearly see people are asking and head scratching. Why is Enbridge going down? Why is the XLU? People saying, oh, they're worried about, what you were saying, the thing. No, they're not. It's debt. There's a lot of debt in there, and rates are just ratcheting up. So you can see clearly which stocks are getting hitting the most. It's the ones with the most debt. So until long-term rates start to turn around, these are the stocks that are getting hammered. And banks are going to get hammered too because they have a lot of debt as well. Bank of America, new 2023 low, right there, sitting on it. KRE is giving back all the gains, so we're looking at those too. I mean, we've got to analyze This has been a good year if you've been in the Magnificent Seven and a few other choice tech stocks. It's been a very crappy year if you've been in anything else.
And it just goes to show us, right? The concentration in the bigger names, right? So if those change tunes, that's when I'm definitely going to be careful. And I think that that's what we need to keep watch now. Of course, with oil moving down, that's also going to start playing into this. And are we running into now deflationary pressures also with the slowing of the consumer? Because I think that this will actually help inflation really finally start taking its way towards that 2%, right? Because we're actually starting to see the slowdown now. I think it's coming. It's
you
here.
imagine if long-term rates go to 6, 7, 8%, you won't have to worry about inflation. Nobody will be buying anything. It's going to be tight credit, really tight credit. So
I think that's what we're in for.
This is what's happening. You're getting these longer-term rates going up. And, if you go to 13%, you don't have to worry about inflation at all. Inflation will be dead, man. There ain't anybody buying stuff. I mean, like, this is what kills inflation is higher interest rates. The long-term rates going off like this is an inflation killer, man. This will punish, but not labor inflation. So maybe I got to check that. It'll kill demand for products, but then everybody says I need more money because I'm paying more. So maybe it doesn't kill it. It only kills the product inflation, not the labor inflation, which squeezes companies even more. So you're in a perfect storm here for a lot of companies here selling stuff. So it is a concern. With that being said, tech is a safe haven because they don't have a lot of debt. That'll just sum it up there. And I'm not saying I'm hiding there. I'm just saying that is why people are hiding there.
Are we going to see more disasters also show up in the banking industry? Because I've been pointing towards that, but it feels like nobody's really kind of keeping their close eye on KRE that just keeps leaking. Bank of America really close to making another low where it was at the regional height, like when things were actually breaking down. Look at that chart. That to me is scary looking charts. You see Citi at below the regional concern. And so things like this, if the global banks are going to start getting hit, I saw JPM take a big hit yesterday. I actually was able to play that short on the downside, got in and out, just took my money and ran. But I'm going to continue watching these banks to see if we keep getting downside because tech can hold this up for so long, though. If we start getting negatives in the banks, we get negatives in the utilities, the healthcare's turn around, where an energy turns around. I think this market is almost leaning towards the bear side now.
You want to see a fun exercise? Bank America, long-term debt, $286 billion. Market cap's 212. The banks, you want to talk about like things that are levered. Nothing is levered more than the banks. So if you're coming in here and saying, yeah, I'm buying banks on this dip, you're not listening to the market here because that is the stuff that is going to get hit the most if rates keep going up. So, I mean, they say, oh, yeah, but, they're going to be able to sell and lend out at higher rates, so it's going to be good for them. Well, now when everybody's got their mortgage locked in at 3%, they're borrowing at 10. So that's a difference. Scary, man.
And it's all about the when these things come to maturity, right? When the tranches come up that are marked to market, a lot of them are just, and I think that was the big concern with Schwab when it had the big decline, is that they just were sitting tight and they had all this debt, and if they had to liquidate, the fear was if they had to liquidate, it would happen. It did get that nice pop, but boom, coming right back down. It's just, you don't know what these companies are holding. You don't know the yields. You don't know when they're going to have to re-up. And with rates at these points, I mean, it's like they've like locked in just some staggering losses here that they're not going to get back, even if the Fed, holds steady here. It doesn't even go up a quarter point. Those losses are real. Those losses are locked in. There's no way to get those losses off the books.
And I mean, we've been talking about fuel prices being the issue with the airlines here, but now they have a whole new can of worms here because they have a lot of debt too. American Airlines, $30 billion in debt. They have an $8 billion market cap. This is a serious thing going to hit on the bottom line if these rates start going up for them too. So, I mean, rates have already been going up short term, but now the long term goes up. I mean, obviously, they're borrowing short term. So, maybe, but I mean, you start looking and that doesn't do anything to alleviate. So as rates continue to rise, all of these companies that have a hell of a lot of debt, casinos. I mean, there are so many examples, so many companies that are just, have so much debt that have operated and have had this ridiculous profit margins for so long because their interest rate, they can borrow money so cheap. Well, those days maybe are numbered, at least in the short term here. And that is an issue.
What about Carnival Cruise Lines?
Oh, don't even. You want to know Carnival Cruise Lines? But just go on Trusty Benzinga for all this information.
I bet you
$29 billion in debt, $17 billion market cap. It gets twice as much debt than they have market cap.
I was going to say double.
They're stuck with that debt for a very long time.
Yeah.
And people say, why you look at market cap, the thing, because it doesn't matter. It does matter, because in an environment where Microsoft can issue an offering and pay off all their debt tomorrow, Carnival Cruise Lines could never do that. They don't even have value close to that. They're stuck with that debt. They have no out. They have that debt on their books forever. And if it goes up too much and you can't service the interest, you go bankrupt. So, I mean, oil squeezing them. So record, and then all of a sudden, if the consumers have, less money to spend because they're obviously the debt payments are higher, then their demand goes down and then you got real problems. You can see how this can just snowball, and you can start to see how mega cap tech, which I've been bearish on, and maybe I shouldn't be, but you can kind of see how mega cap tech is in a completely different situation. They can, if demand goes down a little bit and they have a couple tough quarters, they'll be fine. Demand goes down for Carnival Cruise Lines and have a couple tough quarters, they'll be bankrupt. So, I mean, they got to have records, they got to have record people on those ships because they can't service the debt otherwise.
Zoltan in the chat saying that, oh my God, this sounds horrific. It really is not about sounding horrific. It's just more about painting the environment we're in right now, right? And that we're in a tougher environment right now. Things can always change, but at least for the current moment, things are going to be tougher than they were in the first half, right? We can clearly see that. And now we need to see where's the light at the end of the tunnel here, right? How far out is that light? Is it in the first half of 2024, the second half? Is it in the third quarter, the fourth quarter? Because that's really what's going to determine kind of the longer term outlook, I think, here for stocks, especially if we're talking long term.
And then you can move to the gold silver conversation. And people are like, we're in a defensive environment. Why is gold going down? Peter Schiff could not be more wrong. Do you understand why gold and silver is going down? You know what the yield on gold and silver is? 0. You hold big gold bars. 0. Oh, cool. Well, those cost you 4% every month or 5% every month. Or if they go to Rick Santelli or every year, 13% a year. You start adding it up. Stocks that have 0 yield means 0. Gold, 0. It's this gold. Has no cash flow. Has no anything. Just holding these gold bars and hoping inflation brings it up. Well, if rates go up and inflation starts going down, that's not good for gold. Yield is a 0 on your GLD, 0 on your SLV. Why do you want to own 0 yield when you're getting 5.5% in the bank? That doesn't sound very attractive to me. So the people who are hiding out in gold and silver like Peter Schiff maybe didn't consider that 0 yields suck in an environment where you're going up to 5-6%.
What about the yield in Bitcoin?
With 0, same thing.
Okay.
0, speculative asset. I mean, I guess, they could have Bitcoins and you can lend out your money and the cryptos will say, well, that worked well with all those other, I don't even want to get into all that conversation. But I mean, in this environment here, it's all about, it's honestly about cash to a certain extent. Like it's been about cash. And we've been talking, I've got 50% of my money in cash. Maybe it should have been 100% in cash. I'm glad I moved all those utility stocks to cash, a year ago, though, obviously way early on that trade. But it was the right move because now if you're in all those utility stocks, you're like, oh my God, Enbridge, my only bad one, which I recently bought, which maybe I should eat. I'm down like 9% on it now. I didn't buy it, 2 years ago. I bought it, 2 weeks ago, really, or not 2 months ago, probably. And it had the nice little lift up, but then they had the deal. Now they got a lot of debt. So, I mean, sometimes you got to reanalyze stuff and sometimes you got to eat losses. Enbridge, again, it's about percentage of your portfolio. It's not like 100% of my money's in Enbridge. 2% of my, accounts in Enbridge, 2% or something like that. So I'm like, do I want to eat it? Do I want to lose the loss? Do I want to have some exposure? Because maybe this stuff turns around. You know what solves it all is if rates just start going the other way. That solves all these problems. So I don't know how the Fed starts getting them going the other way now, though. But it would start by not raising next quarter on the short term.
Yeah, I don't think they're going to be able to. Dutch, you also talked about the setup in the PFF. a while ago. And I don't know if you were looking at the 30 or the $31 area, but you were very, very convicted on that one. And there you go.
It's coming
That's just,
down.
yep, it's
You
coming
know,
down.
this stuff here, again, 7% dividend, but full of bank preferreds, full of other stuff. But 7% is, you're starting to get like you're getting paid a little bit. I mean, 4.5 in cash, 7 here, way better than like a Coke. But again, it holds a bunch of bank preferred, some regional preferred. So there's risk, there's credit risk in there a little bit all of a sudden. So I mean, you know, that's an issue. I don't like the PFF here either. But you know, when somebody's saying say something positive, well, we're saying something positive. This is why Nvidia and those stocks are holding up. You know, we're painting a picture here of what is happening because people don't understand what is happening. I don't think they understand it on CNBC. What is happening is they're hammering stocks with debt and they're forgiving all stocks that don't have a hell of a lot of debt. What doesn't have a lot of debt? The Magnificent Seven. So I mean,
And
that's why those stocks are holding up.
And just and the other thing too, and that like when you're looking at these stocks and like this NEE, and you're thinking, oh man, 70 to 52. I mean, I just got to buy this thing. I mean, it's just
Look
a
at the debt.
ridiculous move. So yeah, Standard. When you see these kind of things happen in whether it's a stock or a commodity or whatever it is, it takes a long time for it to reverse itself. There's a lot of institutions, there's a lot of big money that are stuck on these things, and they're going to be coming out. So it's not, it's not something that's going to be cured in, a good inflation number, or I mean, of course, earnings can happen, but just be aware that when you're just trying to catch a falling knife in these things, first of all, it could continue for who knows how long, and then
Yes, it can.
when it does turn, man, you're gonna have competition that are people trying to get out for much higher prices.
Well, you've got people buried. You have overhead supply issues. You have all kinds of issues here now in the utilities. And again, I mean, the yields aren't that great here. The XLU yield is 3.81%. Look at the risk you're taking on for that 3.8. Enbridge was dividend was 8. I was going after a bigger dividend. Maybe that was a mistake, but it doesn't matter. It didn't matter which utility stock you bought. You got hammered in all of them. If you're buying a utility stock, you got punished in the last couple of weeks. And rightfully so. I should be punished because, I should have predicted that, long-term rates were going higher. Wish I had the crystal ball to predict everything, but you can always change your mind.
Are we going to see more of this? This is interesting news. It just hit. Macy's unveils plans of opening up 30 small format stores. I think we're going to see a lot more of this as we continue to see, higher theft issues and things like that. Then we're already concerned about interest rates. Why not just open smaller stores, right? That can save you on a lot of different things and save you on wage inflation. It's a lot of things that it can help.
I like that idea. I like that idea. The issue with Macy's, and this is what people always bought the stock for, like, look at all the real estate they own. Look at what that's worth. You know what all that real estate's worth? A hell of a lot less than it was 2 years ago. All this commercial big box real estate that they own. That's worth a hell of a lot less than it was. We've seen what's happened. REITs we haven't talked REITs. They're just a complete disaster here. I think it's the right move. I think they should have made this move 5 years ago. So maybe it's too little too late for Macy's, and the same exercise, bring up Macy's. You want to know what has a lot of debt? Macy's, long-term debt, $3 billion, market cap $3 billion. So basically their entire market cap is debt. So that's an issue. I mean, PE is 3, 4. But again, if the consumer slows down and they start, not spending as much, that's an issue too. Labor inflation going to be there. A lot of issues going to be there for the Macy's. There's a reason that these stocks are very suppressed.
Also, Lilly has agreed to acquire Point Pharma at $12.50 per share in cash, aggregating in approximately 1.4 billion PNT. Lilly has been starting to show signs of weakness, at least from the strength that it had. I mean, it's just a little bit of weakness when you look at the bottom right chart, right? Of course, but can this pull back a little bit further? I think it could maybe get into that gap zone to the left on the daily. We'll see what happens.
Lilly, a lot of debt too. They do have a lot of market cap, so they could issue, if they need to get out from underneath some of that debt, I'm sure they could issue some stock and get out of it. And that's why we keep doing this exercise. It's a good exercise too. We don't normally have to do this. When rates are flying like this, we got to see what is their capacity to service that debt. So Carnival has no hope. They can't do. I'm not saying the stock's hopeless, but there's no way for them to get out from under that debt. The debt is stuck to them. Lilly could issue some stock and get out of most of that debt. So it's in a little bit better shape. Some of these other pharmaceutical stocks are not that lucky. They don't have that kind of market cap, but they're not crazy. It's not like we were looking at the utilities where they're sitting up at 60-80% the market cap in debt. I mean, some of these are 10%, 5%, 20%, a little bit better. Lilly's just been in a bubble because everybody thought this weight loss drug is going to change the world, and maybe it is. But it's so bubble-licious here, and now that bubble's breaking head and shoulders pattern. I think rallies to be sold in Lilly.
Tough chart on Lilly's been going down. It hasn't really found a great level of support. Down $1.29 on this deal. I mean, really, there's an area. If you're looking for another area ahead of the gap, it's closer to the parallels at the $5.17, $5.18 area. But what your problem is here is like, look at even you had a couple days of consolidation after the 600 to 550 drop. But now everyone's lining up at 550, right? So then you come down a little bit lower. They'll lower their offers down. Maybe today they'll lower them down to 540. People are still sitting on, still sitting on some huge gains even with this decline. So not great support and a big old gap to fill in Lilly.
All right, let's go to our guest today. You guys smash that like.
Angie Setzer, founder of Consus Ag and Consulting. Angie, talk us off the cliff here. I don't know if you've been. I don't know.
I don't know if I can.
No?
Yeah, that's the scary part, right?
Right? Yeah. So,
Well,
how are
let's
you
talk
guys this
about-
morning?
I mean, we're good. The only thing is we see a lot of turbulence out there, right? And I feel like there's a lot of concern. Of course, inflation, we can talk about that and kind of kick it off with that. We've been seeing it trending in the right direction, but can it get actually back to where it was? That'd be my question to start with.
Well, I mean, that's the question that we ask in grains all the time. Like my farmers and I are having this conversation, right? Like, what's the new low? And so when I started in 2005, we were around $2 corn or whatever, and we had the 2008 rally and saw this sort of new plateau that had come in, and so that's been the conversation of like, is $5 corn the new 4, is 450 corn the new 350? What are we seeing here? And that seems to be a kind of common conversation, right? Like, do we see oil stay in this sort of 70 to 90 type range or something of that nature? And obviously those raw commodity costs will have an influence on what consumers are paying at the store or at the pump or what have you. And so, does inflation stay in place, or what do we do that kind of breaks the last leg that we need to get us back to those quote unquote normal prices?
So we talk about the recent price action, and probably nothing moves the grain markets more than the USDA reports that come out. Could you just give us a quick summation of what those reports came out and the implications moving forward?
Yeah, so we get our share of reports this time of year. A lot of times we get a better idea of what we're looking at from a production standpoint. The USDA has, a wide net that they cast when it comes to going out and kind of checking yields and plots and fields across the country. They ask farmers, they ask, grain elevators, people that, around the industry, what we're seeing from a production standpoint. And so in the month of October, we'll get an update on production here in another week and a half. But prior, last week we had a quarterly stocks number. And so for us, what that means is just basically it kind of reconciles the one branch of the USDA, the economic side, with the actual statistics side. And so Friday's numbers gave us an indication, or gave us kind of confirmation of what we had left over at the end of the crop year for corn and soybeans last year. Soybeans came in higher than expected, and so that kind of caught some traders off guard. And it's been part of a trend, and that's been part of the reason that you've seen soybeans fall off so much. Is as of late, a lot of traders have been expecting sort of this bullish shot in the arm, when it comes to the data that we're getting from the USDA or even, from a weekly export standpoint or something of that nature. And we didn't see it. We've seen kind of every time we think we are going to see a reduction in projected ending stocks, the USDA kind of comes out and says, wait, not so fast. And reality is, boots on the ground, actual trades that are taking place in soybeans, kind of continue to indicate that demand is far weaker than what we're used to seeing. And so, Friday's report just kind of confirmed what we're already sensing when you look at spreads in the market structure and kind of that build of carry. You've got the Nov-Jan bean spread trading at its widest level in like 20 years or more. A lot of these things where the market's really kind of saying, hey, keep that supply out of the pipeline. On corn, it was actually a bullish surprise. The USDA lowered ending stocks more than what, traders were anticipating, but it just kind of got wrapped up in wheat getting sold off because we found some more supply there. And we've seen a really poor world market, world demand structure on the wheat side of things. And corn got caught with soybeans. We saw that recover yesterday, but really when it comes down to it, the number came in lower than what traders were anticipating at the end of last week, but it's still just kind of, we have a 2 billion bushel carry out projected for new crops. So when it comes down to it, we're not really looking at running out of supplies, and we're just waiting to get confirmation that the crop is there like we thought it may be.
Let's take us to the meats. What's going on here, right? Are we starting to see a little bit of some topping? Because we could all use the help at the grocery stores. Definitely inflation is taking over. I mean, people probably moving the hot dogs pretty soon, but what are you seeing, Angie?
Yeah, I think, when it comes down to it, is sort of a similar sort of mindset. If we lose that sort of money flow support that we've seen, if speculators decide that it's really not worth it for them to pile in, you'll see the same thing that we've seen in corn, soybeans, and wheat, where the money flow, kind of moving out and looking to move into more of a short position as opposed to what we've seen with a continual sort of buying. You lose that sort of push from behind, and we start to just go back to what a normal market will be, which is relatively thin and not at the levels that you would traditionally see us trading. And so there's a lot of questions, a lot of conversation about what happens, when the cattle herd is the lowest, the beef herd is the lowest that we've seen in decades. And that's not something you snap your fingers, like you can replenish a poultry supply relatively quickly, like a bird from hatching to being ready to go into the market is just a handful of months. The same could be said for a hog. A cow is 18 months to 2 years. And so especially with us seeing, the feed costs increasing and just basically it's very costly to keep a cow back, a heifer back or whatever. And there's such value in selling them too. We've seen heifer retention rates down big time. So you're not even talking about taking a cow into the harvest cycle to become meat. You're also talking about how long it takes to get a cow into the breeding cycle. And so then you're 36 months when it comes down to it, from being ready to breed to producing a cow that's able to make it into the meat supply. And so you're probably going to see beef prices remain really elevated. One of the things that we see though with beef demand is it's primarily hamburger driven. And so we can import cheaper cuts, which no one wants to hear, but the market is what the market is. And so I think you're probably going to see some, consolidation and probably some pressure in that market if we don't see folks kind of continue to ramp up this sort of inflation trade idea that we've been seeing for so long.
Oh, Joel, you're on mute, but don't worry. As long as we don't go to Beyond Meat, Angie, I'll be all right. I can't handle that. Yeah, I need a good steak every now and then.
Yeah.
Joel, what you got for us?
I was just going to ask about the wheat market. I mean, if you were buying wheat
that's
hand
tough.
over fist, I know Mitch was buying that.
What happened? Ukraine,
15,
the war.
yeah,
What happened to all
15.
this?
Yeah, I mean, if you talk about conventional wisdom just not working out here, talk about the wheat. I mean, we just don't need wheat anymore. What's going on? What's the situation in the wheat market?
So the wheat market is a perfect example of everything being worth what the cheapest physical supply is sold for, right? Like basically it doesn't matter what kind of story you want to tell. If Russia's selling wheat for under $7 a bushel into the world market and they're trying to ship 1 million metric tons of wheat to meet their export requirements, you're going to see the market kind of continue to remain under pressure. And so that's one of the things that we've seen is that Russia had kind of supported the wheat market with these floors in place. But the problem that we saw last week is that Romania, Bulgaria, a lot of these countries that have been taking a lot of Ukrainian wheat in and had relatively decent production years themselves, they kind of came in and said, all right, fine, Russia, we're not going to let you maintain this price floor. We're going to undercut you by $5 a ton and sell this wheat into Egypt. And so basically right now what we're running into in grains on an overall standpoint is a lot of our importers for both corn and wheat, are broke. They don't have money. It's costing an extreme amount of cash for them to hold on to supplies. They don't have it. They're trying to finance their debt. They have all of these things going on. So they're very much buying hand to mouth, for one. For two, like I said, Russia's got a massive amount of exportable supply. Portions of it have obviously been taken from Ukraine, so they're able to sell it for basically free. You're looking at, EU supplies are considered burdensome. US wheat exports are a third, down by a third of what they were a year ago. It looks like we could lose another 100 million bushels in exportable demand or export demand. And so there's a lot of things in wheat that kind of continue to pressure it in the cash market more than anything. And it goes back to, like I said, money flow. Money flow rules everything right now in commodities. And so the other thing is the speculator is not going to step in and buy the front month when there's 30 cents worth of carry. You're going to get absolutely destroyed in trying to roll that out. And so there's a lot of different things that are happening that we're just not getting the interest. In the cash market itself says that the end user doesn't necessarily need to be buying futures to hedge their risk either. The supplies remain plentiful. And if Russia's out of the market, then Europe can step in. And if Europe's not available, then the US. And, really when it comes down to it, we're not running out of food right now.
What about weather? And the last thing, and I'll let you go after this. 85 degrees here in Michigan. I'm still haven't put a pair, just wearing the shorts and the t-shirts and stuff. Talk about the impact of the weather and with this prolonged summer. Didn't have the greatest summer, but this heat here.
Yeah, for us right now on the farm side of things in Michigan, my farmers are breathing a sigh of relief. We were really nervous we'd have an early frost at the end of the week last week with the full moon. We didn't. And so now we're probably going to make it into this weekend. And so that extra 10 days is going to provide us some time to really kind of finish the crops. Heat and dryness this time of year is never really we're never really sad about it, I guess you could say, in agriculture here in the Northern Hemisphere, just because it allows you to get the crops off relatively decently and able to get them dried down in decent condition and put away. A wet harvest is a nightmare. We've had a few of them before that last into Christmas time, and that's the last thing you want to see. We do need to start replenishing soil moisture, especially in the Western Corn Belt, and we do need to see some rainfall here in the Eastern Corn Belt to help with soft wheat. We've had winter wheat planting over the last month, and we'll see that continue, through the end of this month. And so we do want to get some shots of moisture and things like that. But from an overall standpoint, this summer has been a mess when it comes to weather. We went here in Michigan from our driest stretch of weather from the end of May to the middle of June to our wettest stretch of weather from the first part of July to the middle of August. And so it's been a crazy year. Yields will likely be variable. There's going to be pockets where yields will come in less than expected. We'll see some test weight reductions, and that'll have some implications on overall supply in the Western Corn Belt because of the heat and dryness that we finished the crop with out there. But from an overall standpoint, really our attention is going to turn to South America now. What's going on in Brazil? They're going to be planting this month. What's happening in Argentina? They're still dry. They had an epic drought last year. And so now in the Northern Hemisphere, we're just happy to be bringing the crops in, and we'll be waiting to see if it rains in the Southern Hemisphere.
Angie Setzer, the goddess of grain on Twitter, is sharing her outlook on the grain markets. Thanks a lot, Angie. We'll dial you up again real soon.
Thanks for having me.
All right. Always great to have Angie. Let's get back to the markets. Let's go to some ratings here. Let's go to Solar Edge trading lower after Barclays downgraded the stock to overweight. From overweight to equal weight here, and lowering its price target to 274. It was 274. It's going to 152. This is a big cut here. It seems like to me they're late to the party. here, and they're just trying to correct themselves. So we'll see what happens. We've been talking about the disaster that's going on in solar, but also this plays into the conversation that we had earlier, right? With rates and things like that. You guys, what are you guys seeing in Solar Edge?
I mean, it's down off the downgrade. That absolutely no help to you here when you had a target at 240. I mean, it's about debt, and here's these solar companies got a lot of debt, so traded down. I mean,
it's
the
not
best
even
way it looks
about
for-
that, Joel. So here you got to even look deeper. You can look at and say, oh, Solar Edge doesn't have that much debt. It's only got 600 million against a $7 billion market cap. But the consumers of these products have to borrow to do the projects. So these projects are not nearly as attractive at 6-7% interest rates as they are at 2% rates. So you have to almost look at what kind of, when you're buying this product. It's like when you're going to, buy a car. You've got to finance that. When you're doing a big solar project, you've got to finance that. So anything you've got to finance as a consumer is an issue. So this is going to kill their demand more than anything. So it's not even an issue that these companies do have some debt. But the bigger issue is that their consumers of their product have to issue debt to be able to finance these projects to buy their products. That's a bigger issue.
And if they're paying, if they have to pay that much more to do the project, then really where's the cost savings come in, right? I mean, there's not nearly the cost savings that they were looking for. So
They're going to need to be giving these things for free soon if they want people to have them. So I think that's what you're going to have to see. More subsidies, things like that. If we're going to see,
and where do these subsidies keep coming from here, Mitch? I mean, we've got the U.S. debt at $33 trillion. That's going to be more expensive to service going forward. So anything that gets a lot of government subsidies has problems here too. Again, you come back and you think, what can I invest in here? It goes right back to the 7 stocks that were trading higher yesterday.
Yeah,
it kind of makes sense.
That's what you have. That's what you have for growth, right? I mean, at least
it makes me not want to be short.
Positive
Apple.
outlook.
I'm at short Apple right now. Maybe I cover it today. Maybe I don't want to be short Apple because there's nowhere else to go. Cash and Apple. That's pretty much the safe stuff.
And you think the ETF wouldn't be that as bad, but look at the TAN, and this is why I try to avoid the TAN. Every time I played this, man, it's just been a disaster for me. Not where I want to be right now. It's not looking good there. Let's go to HPQ of double upgrade here from Bank of America. Looks like they didn't look into the filings yesterday because Warren Buffett's on the selling game here. He sold another 5.125 million shares here at an average price of $25.76. Warren's wanting out. Bank of America wants in. Who's right here?
Bank of America is wrong. So Warren actually usually always ends up being right in a lot of cases here. I mean, HPQ. If Warren is just starting to warm, he has so much stock. If he really wants to continue to liquidate this thing, he sold another. So if we go, he's overnight. He sold how much more, Mitch? You can show it from the Benzinga Pro.
5,125,638 shares.
He's dumping 5 million shares. It seems like every day. I mean, what's the daily volume on HPQ, Joel?
It was 8.5. It was 8.5 yesterday.
8.5 million. And Warren let's just go to the pro. He dumped 5 million. Maybe it was from the day before. Let's go look.
Well,
HPQ,
still,
I want to look at the filing itself. So I'm looking at the filing. I'm jumping right in. He sold over 3 days. Here. He sold over 3 days. Okay. Yeah, show it, Money Mitch. So he did sell it over 3 days. So he doesn't want to be like 70 or 80% of the volume. But if you look down, you can go into the filing. It actually was over the course of 3 days. Boom, but he's like 20% of the sell volume every day. You think he ain't licking his chops into this upgrade and selling? Do you honestly think he's not looking at this and saying, oh, thank you, Bank of America. I can dump some more stock. Give me a little bit of, up volume here so I don't just press it down the whole time. I don't think he's done. I don't think he's even close to done. So you get a pop here. It's going to be short-lived because you got the warrant. As much as Oxy was the buy button at 56.58, this sell button on the HPQ is seems to be anywhere. He just keeps selling it even as it's going lower. He wants the hell out. So if you're buying Hewlett Packard on Bank of America upgrade today, you are not reading the tea leaves, in my opinion. Could it pop up more? Pops up more. Warren will be licking his chops to sell more. I think this eventually gives it back, and I think it gives it back probably within a couple of days.
Toronto bringing
let it breathe, Warren.
Yeah,
let it breathe.
It needs.
I'm just gonna say you got it. He doesn't care. It got up to 26.48 on that initial pop. I mean, it's just so important when you have a day like today, you get an upgrade, you hit a level like that, you back off 30, 40 cents. You got to get back up to that level. So I'm with Dennis on that one. If it gets back up there and continues higher, maybe it has a shot to get near 27. But right now, it doesn't look, it's fallen into yesterday's range already. So if it needs to hold 26, if it doesn't hold 26, I think you get a look at the close of yesterday, 25.67. Just not the greatest day for a double upgrade, too, with Warren selling.
Last thing I want to just touch, of course, KeyBank downgrading Airbnb to sector weight. And we've been looking at this space. Also, we've talked about the airlines. We've talked about cruise lines. Lodging not looking good either. Just last week, I was trying to short Hilton. I was able to get it on a good day. It popped back, gave me an opportunity. Airbnb, I've been short throughout the last week too. I'm keeping an eye on these. These look like they're really going to start getting hit hard. Airbnb, Marriott, Hilton, those three. I'm looking for a continued downside.
I mean, this Marriott, is pretty close to all-time highs here. So, if you've been sitting on this one, same thing with Hilton within, 10, $15 of all-time highs. So, good. Airbnb has been falling off too a little bit. Good support. Well, it's kind of opening into some potential support here. To keep an eye on the 131 area for if you're looking for a possible area to hold in Airbnb.
Again, it goes to show you when these stocks get these pops on going the S&P, they're usually selling opportunities, and it was the case here as well. It's now giving back the entire S&P gain. It had the gap and go up to 151, just a complete gift here. Airbnb not looking great on the charts at all.
All right, let's go ahead and do our wrap up here. What do you expect in the markets today, Dennis? Can tech hold the tide? Because it seemed like yesterday the tech tide was holding everything up, and towards the end we got a little bit of a rally, but of course overnight starting to come down. What are you thinking about here, Dennis?
Yeah, it could happen again. We could have those stocks come in. If the market's reading the tea leaves, it's going to be about debt. And those companies don't have a lot of debt, so I don't think those get hammered the worst. And I think you're seeing it, you're seeing it this morning. They are getting hit here. QQQ is down pretty hard. But again, if you kill consumer demand, those companies are trading at high valuations. So it just brings you back. It's playing cautiously here right now. Everybody was rah bullish last week when we got up to 430 on the SPY, and they're like, yeah, the bears are dead. This is over. And now, boom, just like that, we're back down to the low. So bears are in complete control in this market. You can't get bullish stocks until the TLT actually starts to turn around. I thought it was starting to turn around. It is not. Obviously, that's the case, making new lows here on the move as well. This long-term rates is a major issue for the market here. They need to stop the downward spiral somehow here. If it continues, eventually maybe the Fed says something, dovish, and maybe that turns it around. But I don't think it's like panic and sell all your stocks here either, because I do think this too shall pass. I think we are still near the top of the rate cycle. I don't think it's the Centelli situation where we're going to 13%. He's spooking the entire market with those comments. He was on Squawk Box saying it here this morning. So you could call this the Rick Centelli sell-off here because everybody's talking about it. And it's kind of, he's saying over 10 years. It's just headline driving. So I don't think there's any chance we're going to 13%. Could we go to 6%? Possible. We're flying up through the rates are flying out. I'm looking at 30 or 4.85 here right now, which seems crazy to think about. So, are we done? I think we're near the peak cycle, but you can't control long-term rates. I think the Fed is done, but what's happening in the long-term rates is a different animal here now. They need to stop this spiral.
Technically speaking, we've had just a big sell-off since 4 a.m. Two levels right here. We're trading at yesterday's low, which was defended late in the session because of the tech. So one potential area, and I think I mentioned it yesterday. You usually don't get big follow throughs in the markets until they take out a weekly high or low. And unfortunately, the weekly low is 42.77, and that's within 20 handles here. So take out that weekly low. You're looking at the the upper right chart here. There's definitely some more room here on the downside. I think for the bulls right now to even call it a minor victory today, I think maybe just close it over 4,300, get it back over, hold hope maybe make a low in between that 77 and 94 and get a really rally back up and settle in the 4,300 handle. But as you said, the bears are in control.
And I mean, you can look at technicals and people talking about patterns, and you can look at all that thing. The only thing that matters right now are long-term rates. So we need long-term rates. If TLT turns around and starts to stage a comeback here, this market now is positively correlated with the TLT. So maybe tech can do its own thing to a certain extent, but overall here we are clearly seeing that, XLU, after losing 13 minutes down another 1%. It's like this is the weakest thing every day right now for like 2-3 days in a row. This is people are hiding in this stuff. Thinking I'm playing defense because I don't like the Apple valuation of 28 times, and they're ripping their hair out. What's going on? They don't understand. They aren't listening to pre-market prep. They don't.
Classic financial advisor right now is losing his hair. He
doesn't know. The classic financial advisor isn't smart enough to look at the debt. So I mean, this is what is happening. You have a repricing of debt here right now, and it's a serious issue for everything that has a lot of debt. And utility stocks loaded with debt.
Oh.
All right, that's going to do it for us here on Pre-Market Prep. Like always, you guys can catch us tomorrow. Joel, who will we have on?
Michael Hewson is going to be joining us from across the pond from Chief Strategist over at CMC Market. So that will be our guest tomorrow. Tommy Lackey on Thursday, and then Michelle Krebs on Friday. I've been emailing her back and forth. I go, I don't think we're going to get you. I don't think the strike's going to be settled before you come on. So you'll get some insight from Michelle Krebs on Friday.
Awesome to have you. Like always, guys, you guys keep up with Joel Elconin and Dennis Dick here. Give them a follow on Twitter at Spoos, at Triple D Trader. Going to hit them out of here. Going to go ahead and get you guys over to live trading. That's coming up next. But before I get you out of here, I want to tell you guys, of course, check out our digital investment event. You guys don't want to miss it. The future of digital assets. If you guys want to go ahead and dictate the future, discover your next digital asset investment. It's going to be in New York City, November 14th, 2023. You guys don't miss that. We're talking just a month away from that. If you guys want to go to New York, just have a nice little excuse to get out there. I'll see you guys in New York City, November 14th.